We just witnessed the fastest recovery after a 15% drawdown in the S&P 500 since 1982. So pretty much that's the fastest that I've seen in my lifetime. Since bottoming out in the first week of April, the S&P 500 has climbed nearly 20%. Which is astonishing to think all the year-to-date losses were recovered in just 6 weeks. So does that mean we are off to the races and free and clear the rest of 2025? No, not so fast. In fact, I believe that we could be gearing up for a pullback here in the near term. Now, does that mean we stop buying entirely or pull all of our money out of the market? No, because there's plenty of things that can work even if the S&P 500 is falling back. And that's what we're going to talk about in today's video. Reasons why I believe a pullback is coming in the S&P 500. And I'm going to give you 2 ETFs that I'm going to look to buy in the near term that could benefit as well. So, make sure you stay tuned throughout the entirety of today's video and be sure to click that like button down below to show your appreciation. Subscribe to the channel and let's jump into it. Hey everyone, Ernest here back for another video. As always, I'm ACA and MBA and not a financial advisor. So, please do not take this as financial advice. Alright, let's begin first by talking about why I believe a pullback is coming in the S&P 500. And again, just because I think it's coming doesn't necessarily mean it will. But I'm going to give you a few reasons on why I believe it is in fact. And the first reason is going to be centered around tariffs. And anyone that thinks that the tariff story is in the rearview mirror might be fooling themselves. Because right now, there's still a tariff on pretty much any country inhabited by humans. In fact, there's tariffs on countries that are only inhabited by penguins and seals. Now, that is because of trade loopholes, but you get the idea. However, 2 of the biggest trade partners when it comes to the US happen to be the European Union, which isn't a country, it's a region, and then that of China. And there's still no deal to be had between those 2. And in fact, there's no deal that's all that close. That so-called agreement between the US and China weeks ago was not much of an agreement at all. More of an opportunity to kick the can down the road and negotiate further. But now we find ourselves pretty much back to square one with the countries going at each other in the media for violating their so-called handshake agreement. Elsewhere in the EU, Trump put reciprocal 50% tariffs on the European Union goods. But in the past week, those were delayed until July 9, which was hailed as a positive step. Of the 2 trade deals, I do think the EU is steps closer, but we are still miles apart. When it comes to trade partners here, the EU is actually a bigger trading partner than that of China with a total trade of $976 billion for the European Union in 2024 to China having $582 billion in trade. So, the tariff negotiation story still has plenty of room to jolt the market one way or another. Now, we're going to go on to reason number 2, which is tariffs' impact on earnings. We just wrapped up the Q1 earnings period, which we saw earnings actually be better than expected, which is a term that I hate to hear, but they were better than analysts' expectations. However, the thing to note is a lot of the goods that were sold by companies in the first quarter were non-tariffs. They already had those stockpiled. Now, they had to reorder, get a lot of these new goods shipped in that are now being sold in the second and third quarter. So these items that are being sold now do have tariffs attached to them. So when it comes to businesses, they have a few choices to navigate these tariffs that are bringing higher prices. They can just eat the higher costs altogether. They can pass the higher costs on to consumers or a combination of both. But regardless of which route they decide to go, it's either bringing higher prices for consumers or compressed margins for businesses, which leads to compressed earnings. Think about it this way. If a product cost $20 in the past and a company sold that product for $40, they have a 50% margin. But now, if that product costs $25 with a new tariff and they still sell it for the $40 price, their margins drop to 37%. Otherwise, to obtain that same 50% margin, the company would need to increase their price to sell that product up to $50. There's going to be a trickle-down effect in some shape or form. Lower earnings, lower margins. And that brings us to the third reason, which is going to be centered around valuation. There's valuation concerns right now because if earnings are coming down, that's going to push valuations that much higher. Right now, analysts are still expecting 9% earnings growth in 2025, equating to the S&P 500 EPS, which they're still focused on around $265 per share, which is down slightly from the 270 number to start the year. When looking at valuation, the P/E ratio utilizing those earnings estimates equates to a forward P/E multiple of 22.4 times, which is well elevated above the 18 times average over the past decade. We have an S&P 500 that has been rising rapidly in the share price. However, if earnings do lag and analysts start bringing down their expectations for 2025, that's only going to push the overvaluation that much higher. So, there's plenty to be concerned about with the market. There's a lot more headwinds in my opinion than tailwinds for the S&P 500. But does that mean again that we just put a halt to all of our investing, pull our money out? Absolutely not. There's plenty of areas, sectors, or investing styles where we can still make money. And now I'm going to talk about two ETFs that I think in the near term could outperform. And the first one is going to be the Energy Select Sector SPDR ETF, stock ticker XLE. When it comes to sector performance over the past 12 months, energy has been the worst performing. And year to date, energy is the second worst performing sector within the S&P 500. I am constantly on the search for deals in the market, and the best place to find deals sometimes is in those areas that are underperforming. Energy has been a laggard and there's a lot of stocks, high-quality companies trading at great valuations, but there's reasons to be optimistic about the energy sector. Oil prices are starting to ratchet up higher a little bit. There's still tensions in the Middle East, Russia, Ukraine, and their war ongoing. It could further push energy prices that much higher, leading to outperformance for many of these companies. The price of crude has climbed 58.5% in the past month alone and now trades near $63 per barrel. Over the past 12 months, XLE is down 9% and it has a low expense fee of just 0.08%. The top holdings in XLE include ExxonMobil, Chevron, Conoco, Phillips, Williams, EOG, Kinder Morgan, Marathon, ONEOK, Phillips 66, and Slumber. In total, XLE has 26 total holdings with the top 10 accounting for nearly 75%. By investing in the XLE, you also get a juicy dividend that currently yields 3.5% with a 4.5% 5-year dividend growth rate. And that leads us to ETF number 2, which is the JP Morgan Nasdaq Equity Premium Income ETF, stock ticker JPQ or JEEPQ. And when it comes to JEEPQ, they buy underlying assets, but they also utilize option strategies to generate higher income to distribute that high yield. And that's the great thing about options is there's certain strategies to partake in bull markets. There's option strategies to utilize in bear markets. There's option strategies to utilize in sideways consolidating markets. And you can follow my option trades by becoming a subscriber to the 3 Pockets by checking out the newsletter down in the description below. But when it comes to this particular ETF, JEEPQ managers sell out of the money Nasdaq 100 calls and own underlying positions within the Nasdaq 100 to help generate such a high distribution yield. The combination of dividends paid from underlying positions and the option premiums add up. So why is this ETF a good option to invest in right now is because by selling out of the money call options on the Nasdaq 100, if I in fact believe that the markets could pull back led by technology, those option strategies are going to be that much more profitable, and when they're more profitable, that allows this ETF to pay a higher distribution. JEEPQ currently has assets under management of $26 billion and it is down just 3% over the past 12 months, but it yields a distribution of 11. Which is quite juicy. And the ETF pays its distribution on a monthly basis, which varies depending on how profitable those option trades are. So, if you're looking for an area to park cash right now, JEEPQ is a great spot to earn a juicy distribution and get paid on a monthly basis. So, there we have it. Let me know down in the comments section, what do you think? Do you think a pullback is coming, or do you think this market is heading higher in the near term? And which of these two ETFs do you like in the near term as well? Let me know down in the comments section. And also make sure you join our Discord community of over 20,000 members where we all have one goal in common, and that is to build generational wealth. So, thank you guys for joining today's market update. I hope you've enjoyed this and found it knowledgeable. And if you haven't done so, please hit that like button down below, subscribe to the channel. We'll see you in the next one. Take care.